Hey guys, Joel Frank here, market analyst for YouTrading. In today's video, we're going to be taking a quick look across markets, taking a look at a couple of potential trades that could play out this week. So let's start with the S&P 500. A theme of this video, by the way, is going to be that a pivotal moment this week is going to be tomorrow's Fed meeting. That's certainly the case for the S&P 500, which you can see is actually come back pretty strongly in the last 2 days, especially from this little dip to the 3,860s, actually now flirting with the 4,000 level once again. Now, earlier this week, I did warn that, I wasn't really expecting investors to chase the S&P 500 above the 4,000 level. But if tomorrow's Fed meeting is erring on the dovish side, even if the Fed does press ahead with a 25 basis point rate hike, which is what most people expect, but then Fed Chair Powell tempers any sort of perceived hawkishness of a continued rate hike by laying out lots of conditionality about how they're monitoring the situation with financial stability and the banking crisis in the US, and they're ready to respond, but they're still fighting this inflation battle, so they don't want to stop hiking just yet. If it's that kind of message, something that hints that a pause could be coming soon, but they just don't want to pause just yet, then that could actually spur market sentiment. I think it could create some stability, that create an idea that the Fed potentially is in control of the situation, rather than that the Fed is panicking. And you can see there's this short-term downtrend which the S&P 500 has been capped by in the last couple of weeks. Well, it could actually break above that, could break above the 50-day moving average, and could test earlier monthly highs in the, well, not at 4,000, around 4,080. But, trade what you see. We'd need a break of this technical downtrend to see such a move higher, and then I think it would still be a challenge to get above 4,000 and the 50-day moving average here. And if the Fed doesn't do a good job with the communication, if they do a 25 basis point rate hike, if they make it all about inflation, if they continue to indicate that a fair few more rate hikes are coming, then stocks are not going to like that. Because there's already been a big move in bond markets, big move in Fed money markets to price in a much less aggressive Fed in the coming quarters and years. So if the Fed pushes back against that Fed pivot narrative, then I think we're going to see some downside. And we could slip back below the 200-day moving average, these other key moving averages, below the 2022 downtrend, which, has been in place since the beginning of 2022, and back towards the late December lows. So really things could go either way. It's kind of the same for the dollar index. If the Fed does spur a rally in stocks by potentially being a little bit more dovish, hinting that a pause could be coming, blah, 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 or an outright pause, which is not the base case expectation, but that should trigger further downside in the dollar. The area you'd actually be looking at in the immediate future would probably be around 102.50, which is resistance turns support. We can pretty much forget about these old downtrends now. But that would be the next area we'd be looking at. Equally, if the Fed kind of hashes it up a little bit, it comes across a little bit too hawkish, triggers a sell-off in stocks, sell-off in other assets, maybe gold and crypto, that could potentially spur some safe haven demand for the dollar that could take us back above the 50-day moving average. We can get rid of that line, actually. That's not a good level. But back towards some of these moving averages a little bit higher here, like the 21-day, 100-day. Gold pulled back a little bit, around 1950 at the moment, failed to hold above the 2,000 level, failed to muster a significant break above the April 2022 highs. Now we're just consolidating around this previous yearly high, a little bit below it actually. Just wait and see mode really ahead of the Fed. Like I say, if the conditions are there for a fall in stocks and a rise in the dollar, you're probably going to see further downside in gold, because that would probably mean that the Fed came across a little bit too hawkish. Vice versa, if there's a pause or the Fed manages to come across dovish sufficiently, then you could see the trend extend. Finally, let's take a look at oil. I think You're seeing some stabilization here. Oil fell below briefly, or WTI front month futures briefly fell below 65 earlier this week, recovered now to around 68. But resistance around 70, I think, is probably going to hold for now because, things are getting bad in the US, banking crisis, Europe as well. The economic outlook is rapidly deteriorating. This is certainly a macro-driven move, macro pessimism-driven move, lower in oil. And I think we're probably going to find resistance in this 70 area and then probably head down to the low 60s. Since we broke lower, I've been saying I think we're probably going to hit these support levels from mid 2021 and late 2021 in the 61 to 62 sort of area. Always be on notice though, in case OPEC starts stepping their game up to try and stem this slide, which has now seen oil pull back. How much lower versus that high that we hit in wake of the invasion of Ukraine by Russia? We are down, wow, nearly 50%. That's insane. So this is concerning for the oil producing nations, which were enjoying it when oil prices were nice and high. But yeah, given global macro conditions, I doubt they're going to be able to send oil much higher from current levels. But yeah, guys, in terms of what else we've got on the docket this week, UK CPI, yeah, it should take the back seat really. These central bank decisions from the SNB, BOE should be interesting. Obviously, in Switzerland, we just had UBS buying Credit Suisse, but SNB still going to hike interest rates by 50 basis points by the look of it. Bank of England going to go 25 basis points still by the look of it. Then we've got the flash PMIs out of various Eurozone nations, UK, US, on Friday. Taking a back seat really. To be honest, the data generally taking a back seat, with focus more on financial stability concerns at the moment. Although, we do still want to know how these economies are ticking along. The US, for example, has been outperforming expectations this year. So if that remains the case, well, it's not. The thing is, if there is going to be a bank crisis, it's not going to remain the case for long. That's the thing. That's why all this data is taking a back seat, because a banking crisis is a lead indicator for a potentially rough recession. But yeah, guys, hope you all enjoyed the video. Hope you all found it informative, and I will see you all in the next one.